Capital One Financial surprised a lot of investors when the announcement came out in late February that they were going to acquire Discover Financial Services. This is going to create a credit card behemoth. You've got one of the largest credit card issuing banks acquiring the rails, acquiring one of the actual credit card issuers. I'm Jason Hall. This is Investing Unscripted. We're going to take a closer look at the deal, what these two companies do, whether or not this is an attractive merger and this creates a business that's worth investing in. Before we get to the details, this video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, you should check out our special link. It's fool.com/unscripted. The Motley Fool is going to give you its 10 best stocks to buy right now. Go check out that link. Again, fool.com/unscripted. Okay, let's take a quick look at the press release, exactly what's happening. Discover investors are going to get, if you're a shareholder of record when the deal closes, you're going to get 1.0192 shares of Capital One. You'll become a Capital One shareholder. When it happens, it's a 100% stock transaction, 27% premium based on the closing price before the deal. What I want to show you, though, is what's happened since the announcement came out. Once the announcement was, the stock jumped based on the value of the deal. Now, starting from the day after, once the market closed, Capital One stocks actually continued to run up. Now, what that means is that generally, the market's pretty favorable. A lot of times, if the stock of the acquirer goes down, it means the market might not love the acquisition, or maybe it sees the dilution and is bringing the total per share value down a little bit. In this case, market's saying, hey, this looks like a pretty good deal. Now, let's talk about exactly what it's going to create. So we mentioned it before. Capital One Financial is already one of the biggest credit card banks. This is their primary focus. If you look at their loan book, the majority of it is credit card debt. Now, the benefit of that, the nice thing about credit card debt is really high interest rates, but you need those high interest rates because credit card debt is the kind of the most risky of all of the kind of loans that banks are going to lend. If you think about something like a mortgage, the default rates are very low. People don't want to lose their home. With a credit card, now, there's not an asset that can be repossessed. There's ways to garnish wages and all that kind of thing to recoup those losses, but it's harder to get the money back. So offset that, you charge those really high interest rates. Now, where Discover is really interesting is a lot of people think of Discover and they think of Visa and MasterCard. It's like Visa and MasterCard in that it's the rails, it has the Discover payment network that connects merchants and credit card holders to get the money back and forth. Unlike Visa and MasterCard that are only the rails, with banks like Capital One that actually do the lending, it's more like American Express, that it's also a bank. It's the lender of record. I think that's what makes this really appealing to Capital One, is by bolting this business onto its own, you have two businesses that understand underwriting risk, understand the importance of lending to the safest, highest quality borrowers that you can, your credit card holders, making money on the interest rates for people that carry balances over, but also making money on the rails, the payment processing fees, the transaction fees that Visa and MasterCard and American Express and Discover are able to count as ways they earn income as well. The market thinks that's really appealing, and I think that is something appealing too. And I think that the market is right. That is really appealing. I want to show you just how big of a difference being a credit card bank is in terms of the kind of net interest incomes, the kinds of yields that you can earn versus other banks, commercial banks that offer a full portfolio of loans like home loans and car loans than Capital One does, which their loan book, they have a lot of car loans too. But again, vast majority of it, yeah, it's credit cards. Let's jump over to the FDIC's website. This is a great free resource. Your tax dollars help fund this. You should take advantage of it. We see for Capital One over the past 4 quarters, has earned 10% yield on earning assets. Cost of funding earning assets, this is basically its deposit yield. This is what it pays to depositors and also what it pays on any borrowings that it has. As a result, net interest margin over 7%, which is just remarkable. I want to compare that to Truist Bank. This is the banking, so Truist Financial, of course, is the holding company, and the Truist Bank is the commercial bank. I want to compare those numbers. Yield on earning assets, 5.15%. I think it's basically half of what Capital One Financial earns. Of course, it pays much lower yields on its deposits, less than 2% versus that almost 3% that we saw at Capital One. So as a result, what do you get? Net interest margin of 3.23% versus net interest margin of 7% for Capital One. Now let's take a look at Discover Bank as well. Again, this is the bank subsidiary of Discover Financial. Yield on earning assets, 14%. 14%. It has some other loans besides just credit card, but credit card debt makes up the vast majority of its loan book. 3.55%, so pays even higher cost of capital than Capital One does. But again, 10.5% net interest margin. Its net interest margin higher than the average yield earned by Capital One. So immediately you can see why this would be really appealing. Let's talk briefly about valuation here. I'm going to pull up a price to earnings ratio. I've got Capital One and Discover Financial on here as well. And you're going to see, since the deal was announced right here, they're going to pretty much move in a lockstep in terms of stock price. Just a little under 12 times earnings for Capital One. I'm going to pull Discover off and we're going to look further back. Is that a good valuation? You might look at it and think, compared to the S&P 500, yes, that's crazy cheap. But banks are always cheap. That's because, well, we think of them as the place that has all the money, but they also are incredibly leveraged. So think about a bank for every $10 in capital that it has. That capital is a combination of cash from depositors, equity investments from shareholders, and also borrowings, cash they have from debt they've taken on to fund operations. So every $10 they have, they've turned around and they've lent 9 of that out, and they keep basically 10% roughly to cover inflows and outflows of deposits, that churn of money. So very leveraged businesses. And again, thinking about that 12 times trailing earnings for Capital One, that's not cheap. If you look over the past few years, we've had some lag from the pandemic, concerns about higher defaults on credit card debt and that sort of thing. But it's not cheap, I think, is the key thing to remember. That means the market's pretty favorable on the deal. I think that's important. But when you're buying a bank, it's important that you pay a reasonable valuation, especially these large, mature banks. In this case, Capital One, it's looking to juice its growth by this acquisition and accelerate its credit card issuance, and also earning money by owning the rails too, and the payment processing fees that are part of Discover's income stream as well. But again, getting a good valuation is really important. Okay, so we've talked about the merger. We've talked about the extreme profitability of the kind of loans that they issue, why that's really appealing, why this looks really attractive for Capital One. We've talked about the valuation, why the valuation is a yellow flag for me, that you're not buying cheap here. You're counting on things going really well and great execution of the merger of these two really large businesses to create something substantial. Now, could happen. The odds are favorable that the end result could be good, certainly good for consumers, maybe good for investors. But again, at this valuation, I think there's some yellow flags right there. Let's talk about why I think those yellow flags are really important right now. And that's because when you merge these two businesses together and you start trying to execute on leveraging all of the things that both are good at, reducing redundancy, wringing out excess costs, and getting your technology to work well together, you always have to think about the cycle, especially with banks. These are very cyclical businesses tied heavily to the consumer economy. And that's even more so the reality for credit card banks that focus on credit cards for the majority of their business. Now, we're already seeing some signs that there could be more trouble to come. I'm going to show you from both companies' most recent presentation, and we're going to highlight a few things right here. This is for Discover, and on the far right, this is the end of 2022. The left, this is 2023. And what we've started to see is delinquency rates, both 30-day and 90-day delinquency rates, have started to increase. The gross charge-off dollars are starting to increase. Let's take a look at Capital One. For its US-based credit card issuing business, we've seen its delinquency rates start to increase as well. So I think it's important to note that, again, it's not a sign that we're about to go into recession, but it is a measurable, meaningful concern. This could make the process of merging these two businesses together increasingly painful, is if the two businesses are dealing with an economic downturn at the same time they're trying to merge the businesses together, could cause the merger to take longer, could result in higher losses than expected during that period simply because of the focus on getting the two businesses combined. Could take their eye off the ball a little bit on making sure they're really laser focused on good origination and lining up the best customers to lend to. That's a risk. That is a risk you need to consider. You're interested in investing in lending. If you want to invest in banking and you want to position yourself well, instead of investing in this kind of higher risk time right now where you're paying a little bit of a premium for Capital One versus its historical earnings multiple, I think a better idea might be to either think about trying to find a better value opportunity or invest maybe in a best of breed business. Let's talk about best of breed first. We're going to go back to the FDIC. We're going to talk about American Express. What you're going to see here is some, again, very high profitability, 11% yield on earning assets, higher cost of funding, net interest margin of 7.45%. That is a wonderfully high number. And what makes American Express so appealing is how it has continued to evolve and find its best success, provide value for customers, particularly high spenders, high net worth individuals, people who travel a lot, and create a wonderful rewards program that is incredibly sticky. And oh, by the way, those customers that it tends to attract usually are the ones that can afford to continue to pay the bill, not the ones that are having to decide to skip the credit card payment because money's getting tight and they have a utility bill that they have to pay first. The quality of its borrowers is a differentiating factor. Now, like Capital One, American Express stock is not cheap right now, but what does it have going for it? It doesn't have a giant, complicated acquisition to try to merge into its existing business and combine to make a strong business. So if you're going to pay a premium, I say pay a premium for the premium business. And I think American Express is that. If you want to own a high quality bank that's also big in credit cards, American Express is the one that really stands out to me. Now, if you're looking to bargain hunt, if you're looking for value, we're going to go in a different direction. We're going to talk about one of the largest regional banks in the US, and that's Truist Financial, which has a dominant presence in the Southeast. And the stock is trading, to me, at really discounted prices on an earnings multiple basis compared to any time over the past 5 years. And it's cheap. It is very cheap. As a result, the dividend yield has been pushed to some incredibly attractive levels. 5.5% yield at recent prices. Now, its ability to grow the dividend, besides modest increases in coming years, I think there's some real reason to expect that you're not going to see supercharged dividend growth. But starting at a 5.5% yield is a great baseline to earn really solid results. And that's just expecting the business to perform fine, right? You don't need a superstar perfect execution result to be happy with the returns that you can get from Truist Financial. Now, I do want to share Truist, again, Truist Bank. This is the bank that the Truist Financial Holding Company owns. Very different profile, yield on earning assets, 5%. It's about half of what we saw even from the lowest of our three credit card focused banks that we talked about. Cost of earning assets, 1.93%. Again, it's on the lower end. Net interest margin of 3.23%. That's solid. That's certainly acceptable, high enough to generate solid income, protect its cash flows, have a strong balance sheet, make sure investors get paid on that dividend. So there you go. There's four bank stocks that we just talked about. You got the big merger with Capital One acquiring Discover. Why I think right now investors should maybe just keep watching it. Not the best time to necessarily invest. If you're looking to ride the long-term wave for credit card banks, why American Express, the premium brand, is appealing to me. If you're looking to bargain shop, why Truist Financial is the place to buy.